Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark discusses the close connection between gold, oil, bonds, and the Canadian dollar. David Gurwitz from Charles Nenner Research points out the importance of following natural investment cycles. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always a pleasure to be with you, Jim.
Well, we've had some interesting numbers, and you say it's one of those follow the leader, and we're leading with?
Well, it's we'll start with the gold market, and I think that will lead us into crude oil, the Canadian dollar, the bond market. There's just a whole series of I wouldn't say dominoes that fit into place here. A couple of months ago, we saw this bottom in the precious metals right around the first part of November. We had silver, most oversold reading in years, the silver to gold ratio providing relative strength levels that we hadn't seen in a long time. So that then put in the bottom in the gold and silver markets, and we got a two-staged rally off of there into the middle of January, and got up to some price levels that we've been looking at. Originally we talked about 1255, 1270 as a resistance, and with 1290 as the next level. And as we got to there, we had some huge increases in the speculative long positions showing up in the commitment of traders numbers. We had a 45% increase in the numbers over a 2-week stretch. The commercial positions on short side increased percentage-wise about the same, as we were into that $1,290 to $1,300 range. So as we talked about last week, that creates a vulnerability to the marketplace because you've got the wrong people becoming overstretched on the long side, and all it takes is a little bit of negative news or a failure of the market to follow through on the upside, and you end up with liquidation pressure starting to kick in. So this week we started off the early part of the week with one hit in the gold market, not too big, probably about $20 or $30 worth, bounced back to test the highs. And at the end of the week, we've broken, closing off the week here around 1235. Now the COT numbers, as of the release on Friday, just down marginally, only down about 5,000 contracts on a net basis, and that's for levels at roughly 200,000 in ballpark. So a very small decrease. We invariably need, at least a month to clean out the speculative positions before the market has been capable in the past of having a concerted rally. There's only one time, 1993, where it managed to rally for an extended period after being this, having such commitments in the marketplace. So that then leads me to the fact that the oil market tends to bottom out 2 to 3 months after the bottom in gold. So we've had this bottom in gold, a good rally, and then a week or so ago, we started to get these real downside capitulations in the oil market. As we've broken through 50 and then basing out around the $43 level. And this week became the first week with any kind of a significant advance at all in the oil market since back in June. I mean, you've got to go back many, many months here. So the classic action in the oil market is that you don't create a V bottom. You tend to create double or triple bottoms, and it takes a couple of months to do it. The initial rallies, and this is looking back, there's probably half a dozen of these really, really hard breaks over the last 2 or 3 decades. And the initial rallies have been 18 to 23%. There was one back in 2009. That first rally was a 40% rally off the low. And those tend to take 4 to 7 days. They are really fast. You've got all those short positions that have built up over the last few months that have been very profitable. And usually at the tail end of that, once again, just like the upside in the gold market, the downside in the oil market ended up with too many shorts. And so as it kicked up off the lows, there's a lot of short covering happens. And to say that can take maybe just over a week. This rally was 24% in 4 days, pretty much in line with what you'd expect to see. The rallies typically come up just shy of the 50-day moving average. This one did just that. It was about $1.25 shy. We had rallied from 43.60ish up to 54.5. Excellent rally. And at the end of the week, we closed up on the week, as I say, for the first time with any significance since the summer. And that's basically 7 days now off the bottom. Well, from here, we'd expect prices to go back down and retest the lows, and thrash around with a lot of volatility. As we mentioned before, we should be getting into less of a trending phase like we've been having, and more into a real choppy bit of action. And the oil stocks, we talked about that last week, how they've been holding in so well following the tax loss selling in the middle of December. The two pullbacks that we saw in January were at much higher levels, and most of the oil stocks just had an excellent stretch into the middle of this week, and came on strong a little bit towards the end of the week. I think you want to be looking for pretty deep corrections again in those. Maybe look for them to drop a good 20% off maybe 30% off the levels that we saw at the end of this week.
What about some things we haven't looked at lately, like transportation, airline stocks with lower prices of oil? Have their stocks improved?
Yes, well, you've seen a lot of improvement. I look at stocks like Alaska Air and these. They really priced in the break in the oil a number of weeks ago, and they're starting to have some difficulties up here. So I wouldn't be at all surprised that the low energy prices are going to help them over time. There's no question about that. But the market's a forward-looking mechanism, and I'd be fairly cautious about the sector right now.
What about commodities like the grains, copper, and maybe some of the precious metals?
Well, the base metals, copper had a better week this week. Finally got up here into from the 240s, pushing 260. I would say 260 is a bit of a lid in here. If it can't get through there, I'm still looking towards 210 as an optimum support area beneath the market. Grains look interesting. Corn and wheat have come off the lows fairly well, seem to be building some nice bases from the October lows across to where we are right now. They're looking a bit like a double bottom that might have some decent potential in there. The one that really stands out this week in terms of an item that made an extreme to me is what we saw in the interest rate market. The bond market yields were down to levels that close to what we saw back in 2012, and I got we're at the bottom of a declining channel that goes back to the early 1980s for bond yields, and this also then correlates with what I see in the oil market, because the type of extreme we're seeing in bond yields right now, this is the 20 and 30-year ones. We've got, I think this is like 6th or 7th time that I've had what I call a capitulation on the weekly and monthly charts. And each one of those produced a low in the oil market within 2 to 3 months. So sort of fits into the general idea of a basing and choppy bottom for the oil market. Now, in terms of the bonds, The long bond contract, the futures, topped out around 151. This is up from the January low of last year, which was sort of in the 127 range. And for the bond players, that's an exceptional move. And it's now got to that point where we think it needs a pretty sizable correction. And the employment numbers out of the States on Friday were enough to really cause this bond market, which had been rolling over for 1 or 2 days, to really take it on the nose. And bonds closed off around 149.5. I would see initial support there at 143. And if we don't get a good bounce out of there, then I wouldn't be at all surprised that there's much lower bond levels to come as we move through the spring and summer.
How are Canadian financials doing? I hear the TD Bank now has more branches in the U.S. than it does in Canada. The Royal Bank wants to bail out of the Caribbean, while the Scotia Bank thinks the Caribbean's a great place to be.
Yeah. Well, the banks, most of them, the profitability, a lot of that has come from trading and from underwritings. That's dried up a lot in the last few months as the markets have started to chatter around, and as like the Canadian energy markets are not providing them with the returns that they would be looking for over there. So, I think you're ending up with these Canadian banks. Probably, we've seen the best, and they're probably going to thrash around up here. If they get a little bit higher in terms of interest rates available, that'll help out the spreads that in terms of their markets, their lending and borrowing rates, so they can pick up a little bit there. But the yields are still attractive for people who are looking for cash flow. They're attractive. And from a technical perspective, the lows that we saw in the last 2 or 3 weeks, we had a pretty good week this week, but the lows we saw in the last 2 or 3 weeks, I think those are going to be pretty critical from a technical perspective.
Ross, if somebody needed some investment advice, how can they get a hold of you?
I'm at CIBC Wood Gundy in Vancouver, and my number here is 604-661-7759. And the email address is ross.clark@cibc.ca.
Ross, thanks a lot for chatting with us.
Thank you.
After the break, David Gurwitz on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to David Gurwitz, Managing Director of the Charles Nenner Research Center. Welcome to the show, David.
Thank you. It's my pleasure to be back on your show. I really enjoy it.
First of all, maybe just let our listeners know that you have a special offer that's available to them.
Yes, people should, hopefully, if they listen, they like what we say. That's the first thing. If they do, to write to charlesnenner.com and say they heard David speaking on the show, and they get a free month trial of the research we send, which I will refer to today so people will be somewhat caught up, covering moves based on cycles, technicals, and target in stocks, bonds, commodities, and currencies.
David, off the top, one of the interesting things in your research letter, the 100-year war cycle. Right. And, of course, we have ISIS, the horrible burning of that pilot in a cage. Are we engaged in what could be described as the Third World War?
Well, I wouldn't say that. Let me answer your very good point about what we covered. We look at cycles in everything. What's a cycle? It's a repeating top to top in any data series, going back in anything, stocks, bonds, commodity currencies, war, famine, etc. So one of the things Charles Nenner did, he found a war in the major war in the second decade of the last 2,000 years. And you saw that, obviously. You saw that report. And it's available if anyone listening should write in. We'll send them that so they see that humans repeat. It's slightly different facts, obviously. They didn't have cell phones back then, but somehow every 100 years seems a major war starts. Obviously, 100 years ago was World War I. 200 years ago was the War of 1812. and it goes back literally for 2,000 years. So ISIS, while they're horrible, they wouldn't have showed up 20 years ago, according to us, because cycles determine when things happen. It's not the free choice we think we have, which is not so easy for people to get their hands around. But we think the war cycles, when you put together the next 3 or 4 years of stocks, will be essentially down and up, but not crashing till about 2018, and then pretty rough years going forward till the beginning of the 2020s, when we look like we'll have a very big stock run up for that decade. It's not going to be so pretty the next 7 years in stocks nor in bonds, because we think the interest rate cycles over the last 60 years have bottomed, and they're going to start going up again, so you're going to see a decline in bonds as well. It's not going to be so easy for people who want to be long stocks and long bonds. They're going to lose, whereas the last 30 years, had you been long stocks and bonds from 81, you would have won, with their knockdowns along the way, because rates were 18% in 81, and the Dow was 1,000. Now the Dow's 18,000, more or less. So it's been up 18 times, 30 some odd years. We don't think that will continue now, nor do we think bonds will stay at 2%. They're going to go back towards 18 again. In a nutshell.
Any idea why we have this 100-year war cycle?
Yes. We're humans. We don't change. We repeat what we do from the past. And it's a very deep question. And everyone likes to think they have independence, freedom of choice. I like this car. I like this ice cream. I like this movie. So I have free choice. And we don't think so, based on the past. Charles Nenner found this system while he was in medical school in Amsterdam in the late 70s. The professor said they put more doctors on call in hospitals during a full moon because there are more births during a full moon, which makes sense. And then about a month later, the professor said people get admitted to insane asylums all around the world at the same time, and they didn't know why. And Charles told me when I first met him, he was working at Goldman Sachs at the time, he said, I told the professor it must have been during a full moon. People get crazy around the world at the same time, and the professor said, no, it had nothing to do with a full moon. So that's when Charles started looking into patterns, came to New York in 1981, and he watched some show where a guy named Neil Cavuto, who's actually pretty well known now, but was starting a business show, said IBM went up because of this. And Charles didn't know anything. He said, how do you know why it went up? And he went into the library in 42nd Street in Manhattan and asked them to bring out old Wall Street journals or New York Times. I think it was Wall Street journals at the time. And by hand, he found repeating top-to-tops in the IBM prices, closing weekly prices. And he went back 30 years then, and he found cycles, which are sine curves really, have to be equidistant, meaning every 6 weeks was a top, every 19, every 37. It looks like a bunch of EKGs superimposed. They were all bottoming at that moment. He said, that's the reason why it's a bottom. All these past patterns are bottoming at the same time. And that's the basis of the cycle work, believe it or not.
So when you apply that to this war cycle, why would that happen?
Right. Well, that's the point, that if you find a pattern, unless it changes, we expect it'll continue. So here we found a pattern going back 2,000 years, second decade of every century, you had a major war. And so we just assumed it's going to continue. I'll read some of it now. Obviously, 100 years ago, World War I, 1802, Napoleon starts, 713, Spanish War, about Spanish successor, Jacobi Rebellion, 1618, the 30-year war started in Europe, 1517, Martin Luther starts Reformation, 1415, the Battle of Agincourt, part of the 100 Years' War, where the English beat the French, 1312, Byzantine Civil War, 1200, Anglo-French War, 1109, Battle of Glogau in Poland. It's interesting, 1013, the Vikings attacked England, 907, Russian-Byzantine War, 814, Charlemagne united West Europe, 711, Muslims under Tariq invade Iberian Peninsula, 618, China collapse, Sui dynasty.
David, I wonder if part of that cycle is humans have, of course, memories. Is it perhaps after 100 years we forget the horror of war and it sounds glamorous again? That's
a great question. I'm very proud of you. Cycles indicate that we forget. You're saying it from another way. But cycles indicate that things repeat, and we forget about it, and it comes back. So, hemlines go up, hemlines go down, they seem to be in patterns.
Well, I watched a great documentary on the First World War, and a lot of it was Europe had not had a major war for a long, long time, since Napoleonic times, and they're going, oh, glory, we'll have this thing over by Christmas. Both sides were saying, God is on our side, we can't lose. And of course, 16 million people are dead 4 years later.
Well, Hitler thought he could send his troops without coats into the winter. It would be fast. Thank God he did, because that was one of his miscalculations. That was 100 years ago. You call ISIS, that's not a big war. Our stats are on a big war, and there's spots all over the world that could go, Europe, the Far East, and so that's what we think's going to happen. Charles said this 4 years ago on TV. Nobody was thinking about it. So basically we do this with stocks, we do this with bonds, with crude oil. We just called the top at 97. 4.5 years ago, called it at 147. So all these fundamentalists say, how could you not factor in all the things going on? And my response is, are you, who thinks about this stuff, able to call those tops and bottoms? If you can, you don't need us. But since we don't think about all the details except price, because price is the voting history of what people thought of crude. Crude, by the way, has only been around trading 100 and some odd years. It's been in the ground a lot longer, but like 1700s, there was no crude oil floating around that people knew about. 1800, they didn't know. 1850, I think it was the late 1880s that they started even with the first couple of wells and didn't really get going to the beginning of this year.
And part of that was they were running out of whale oil.
Correct. You know your stuff. So that's our crude stories. We think it will go back up. But it won't really get going for months. But we think it will go back past 70 and then past 100. And so you could say now, what's the reason? We don't know. We're not smart enough. In 2008, if you remember the crash in stocks towards the end of the year, crude was lower, and everyone was hoping crude to go up because it would be a sign of enhanced economic activity. Now if it goes up, it'll be because there's potential terrorism on all the different places, and Mr. Putin needs to increase his revenue for his country. That's the arguments everyone's going to make. We don't know true, not true. We have no idea. All we know is we'll tell you when it's going to happen, if it's going to happen.
What is going to happen with oil and why? And I'm also wondering, if oil prices are down, what's going to happen to all the push for electric cars? Are people still going to do it just because it's good for the environment? Most people I know tend to look at what's it going to cost me to go electric and what's it going to cost me to stay with gasoline.
Correct. Again, like I say, we're not that smart to know all that stuff. All we know is crude was at 100 for several years, was at 147 at one point, if you remember. And then 6 months later, it was 49 again, because we had called that top and nobody else did. So I think we're going to see it up again, and all those other things, the Musk battery cars and things, we're going to see, because we're not going to keep, crude will not stay low, even though the argument is we have an extra 1 million or 2 barrels a day extra in world production as opposed to use, so of course it'll stay down. All this A implies B logic we don't believe. We believe the past will repeat, and whatever particular new circumstances are, it will repeat regardless.
We're speaking with David Gurwitz, Managing Director of the Charles Nenner Research Center. I'm wondering, are all these wars connected to currency battles and trade battles? Are they pretty well mixed up and connected?
Well, the answer, not from the way we look at things, but one would argue, of course, because a currency is part of the way a country expresses its business. So they all have currency. Having said that, let me just talk about currencies for a second, because we do believe the dollar is topping in April, down a bit, and then back up by the end of the year, and then it starts a major decline. We've been calling the strength in the dollar for quite a while, for years actually. We called the first 3 months before the first Greek crisis, when the euro was 151. We said it was a major top, went down to 122 and then 118. Obviously, currencies also affect countries. That's why the euro and the inability of countries to weaken their currency and therefore make their exports stronger and easier to have is something that affects everybody. We don't know, like I say, we're not smart enough to know why a war would be between a country and another country given their currencies. We can just tell you how we think the currencies relatively will be valued because of the past. That's the job we do very well. Why and what effect it'll have, we don't know.
And what kind of a battle do you see with, Greece? Of course, everybody says that's the loose cannon. If they don't pay their debts, that could cause a worldwide banking crisis. Are they on the edge, and do you see any cycles that would predict that?
Well, we don't know. Again, they're part of the euro, so we don't know in particular there, but we do see the euro going to par, weakening. Whatever that means, Let me give you a nat gas story to indicate the connection between perceived news and what we think's running the show. Before fracking, which I assume all your listeners know is the horizontal type of drilling, which through tight rock formations as opposed to the vertical, that ran the show for most of the time until the U.S. started, putting out the equivalent of 2 million barrels a day. Nat gas was once $24, and then it was 12, and it came down to 6, and everyone thought it was going to go back up. And our cycles and target algorithm, it's not just direction, which the cycles tell, but it's also a target algorithm that's kind of based on quantum physics. That's all I'll say. It's a little complicated. It said it was going to go to $2, and everybody didn't believe it. So $6, $5.50, $5, $4.50. A bunch of Canadian banks had made loans to Western Canadian nat gas producers when it was $6, and all of a sudden it's $4, $3.50, and just like house loans are underwater, so are corporate loans. If you make a loan based on collateral being $6 and all of a sudden it's close to $3, you got a problem. So the banks forced the Western Canadian gas producers to start paying them back. The only way they could do that is by increasing what they were pumping in the gas and the fracking, and that increased the pressure on prices because more supply was there. So the newspapers reported that nat gas prices went down because of forced bank selling to repay loans, which was true, but that's not what was the real cause. The real cause was cycles that had topped, had to head down, and then the news and actions have to come along in that set of circumstances. So there's an example of us saying we had the benefit of cycles and target to tell us what was going to happen, and then in fact they claim it was other reasons that happened, and we don't believe it.
Speaking of currency and cycles, what's going to happen to the Canadian loonie?
The Canadian years ago it's interesting, when 25 years ago, Canadian was higher than the dollar. Then it went down, I think during the time Trudeau, the current person running, his father came in and socialized a lot of things in Canada, and it went to 66 cents in the dollar. And so was the Aussie at the time. And we predicted, it's not that long ago, 5-6 years ago, we predicted that they would go to par. And everyone thought we were nuts, and they went past par. We think it's, right now, let me read you today's report, what we said about the Aussie. Good question. I can't remember everything, even though I edited it. Aussie dollar, Canadian.
Yeah.
While we're seeing the expected strength in the Canadian versus the U.S., we still need to close below 123.15 for a buy signal. Dollars Canadian cycles have topped, so we're going to see Canadian dollar strength now. That people could say, well, of course, because the crude's going up, and a commodity currency always operates that way. The answer is it usually does, but not always. It just so happens we think crude's bouncing, and we think the Canadian is going to get stronger, and the Aussie, which is also a commodity currency, it's what's considered. We wrote today, close above 79 Aussie dollars, a first indication of a short-term low and a short-term buy signal for the Aussie. We called both of those to par, as I mentioned years ago. So the system is usually right. It's not always, as humans came up with it, humans wrote it, so it's going to be imperfect, but it's pretty good. And it's important, we think, the users of the service, and people should write in to sample it, they should really do everything, even if it's things they don't understand, because the system works, and it doesn't really matter what the letters are, USO, oil, crude, gold, S&P, best to do everything we're writing about because it's a math system, and that'll mathematically increase their chances of having good trades.
Well, another person that we talk to quite often, Tim Cyclesman Wood, I think is a strong believer in your system where he says, I don't watch the TV. Someone will claim because there's a war here or a monetary crisis, that's what caused this particular thing to happen. But actually, if you look back over the decades and centuries, it's a cycle. And no matter what, humans like to connect, there was a comet in the sky and the stock market went down. There must be a connection. And
right.
Yet you're saying there isn't.
Right.
There's some other reason behind it.
Right. We're not smart enough. What we're smart about is coming up with a system that can do a lot of stuff. It doesn't just find top to tops in any data series. That's what cycles are, giving you direction. It also has levels, which is important. Like we say today, buy UNG, not gas, and we give a level, we give a target level where it should go. Most research places don't because they don't use maybe the same type of methodology we use to come up with a target as well as direction. So it's not so easy it's like a football quarterback going back, Tom Brady, 1, 2, 3, 4, and then he throws to the spot. It's timing, and that's level. The same thing with us. We want to know timing, which is the cycle, gives us like the top next week, bottom in 2 weeks, whatever it is. And level is how hard you throw and where we think the particular stock or bond or commodity or currency will reach. And that's a separate thing than direction.
I'm Jim Goddard. We're speaking with David Gurwitz, Managing Director of the Charles Nenner Research Center. David, people have questions about where is gold going, silver, and the major stock markets. What's happening with gold, and what do you see with your cycles?
Gold, let me read you today. It's a tricky trade right now. We did call the top in 1900 after 11 years up, so that was pretty good. And there have been a bunch of bounces since July. Let me read you. Gold did not close today. It didn't close below 1249 daily. Cycles are still up. So in order to generate a buy signal, we need to close above 1280, meaning even though cycles are up, other technicals have to line up for it to go. Just don't be short. We think gold is 1450 is the top this year. It may turn down substantially after that because that would reinforce that we might be in an Elliott wave 4 up, and then it comes down. And then, if we're not sure, and if that's the case, we look to go long because we think it will go way past its highs. We think gold will have its day. Those who listened to us went out, so they're not going through the aggravation that people had buying it all the way up to 1900. Silver is similar. It's just not the same number. Silver, it reached $50 at one point and came down into the teens. We think it will go back again. We don't think these moves start until several months from now in terms of the more secure major up moves, but we do believe that's what's going to happen.
What about the Dow and S&P?
Right. Well, I'll read you today's stock report because people will get this. S&P, NASDAQ. The bounce in U.S. equities continues. Some daily cycles are up. Our overall technical model became a bit more positive. However, as mentioned a few weeks ago, only a close above 1270 futures will lead to new high. And it's an important number. As long as we don't close above it, however, we expect to see the trend of the last few weeks. Swings of 5% up and down in a very short time period. The following closes would indicate the end of the bounce. S&P below 2030, NASDAQ below 4180, and the Dow below 17675. Europe is actually showing a mixed picture. The DAX has done very well. We repeat, the overall technical model is giving a flashing overbought signal. Some dailies look toppy, and the DAX and TSC and the AAX their buy signal will be canceled below certain levels, and we're going to discuss the Far East next week. We have clients all over the world, so we have to kind of cover everything they majorly trade in. So the stock picture is we're going to be turning down is what we think now, and April is a major top in stocks for quite a while, like years.
What about the bond market?
Bond market, we think still has a little bit more bounce to go, but it will also turn down towards the end of the year, if not earlier. And then we're going to have a mess. stocks down and bonds down.
What about, I've heard they're now offering negative bonds. Who wants to buy something that's going to lose them money?
Well, that's what's going on in Europe. They're doing that in Germany. So, because here, I hand you $1 million and you can't get yield, but you don't want to take a risk. See, with us, we think someone has $1 million, whatever it is, you can go to the bank, assuming you get positive pre-tax. How much are you going to get? 2%, 2.5%. Our attitude is if you put it into trades with tight stops, with us, you probably outperform the bank by a factor of 3. And that's kind of safe. If you put in the stops, you really can't be hurt too bad. And we think that's the best way to go, especially that rates are low. If rates are 10%, nobody would really mind. Here, I have $1 million, let me just get 10%, not so bad. But there's no yield now. So older people in particular are feeling stressed. They're not getting any type of return. $5 million is $100,000 if you look at it as 2%.
Have you seen any kind of a cycle that would explain or tell us what's happening here with interest rates? They've never been so low, and I don't think we've ever been in a situation where you would lose money like this before.
Well, the answer is they were 60 years ago. Rates were 2%. The U.S. government was selling savings bonds 2.2%, 1953. So it's been a 60-year cycle, 30 years up to the beginning of 2001, when rates got to be 17, 18%, and now they're back down. There you see a 60-year rate cycle. We think that will continue, meaning it'll start to go up soon. Just based on nothing but that is what we think is running the show. Now, there's other cycles as well, so we try and make them all line up. But that's one in particular. So 1950 rates were low, 1920 rates were high, 1890 rates were low, and in 1860 the Civil War rates were high. So there's a 60-year complete cycle in bond prices.
People mention the word deflation. Some are saying that's good. Others are saying it's bad. Who is it good for and who's it bad for?
Well, that I won't answer because that's not, you know what I'm saying? You should ask your economist. I don't, it's obviously.
But you can tell us when it's going to happen.
Yes, we did. We called this deflation. We've called this. Charles has been talking about this for a few years. So we called this exact move, the deflation in commodity prices. Look, we haven't had deflation in stocks. We haven't had deflation in bonds. We've actually had inflation in those, but basically the other things we're going to have deflation a bit more still. And then at some point we'll turn around. We're going to have massive inflation.
What kind of cycle do you see for real estate?
We're not so good at real estate because there's not enough transactions. We don't know how to peg real estate. There's Steers and Cohn. There's a certain ETF for that, but we're not so smart about that, and we just need data to be able to massage in terms of trading. And there's not that much real estate trading.
What about people who are looking to get into junior equity markets? Is that going to turn around?
You mean
like
offshore?
Yes, or the
Canada,
venture exchange here
China,
in Canada.
Right. Each one's different. India, each one. That's what I'm saying. Your listeners should write to us, and they'll start getting the reports where we cover. We cover Brazil a lot, the Bovespa, because we have a lot of Portuguese clients for some reason. I don't know why that came, but it came, and so I would say that again, real estate we can't do too well, and because we don't have enough data. Facebook, we can't do really so well because it's only traded less than 2 years, so we don't have only more than 24 monthly cycles. We like to have like 5 years of stuff.
So the high-tech stocks are brand new?
No, just that one.
Oh, just that
Apple,
one.
we've done a pretty good job. Recently we didn't, but when we called the top at 702, it was a very good job.
And what is Apple's future?
Well, it's up to 116 now, so it looks like it's going to hit a little bit of a wall, but medium term it's strong. The news is not in everybody's face, and assuming we could do that, and then when we do our job, people feel comfortable that this keeps them objective. They don't get beaten up by watching the news all the time or listening to it. You happen to be a show seeking honesty, so that's why I like to be on your show. But not all are like that.
Yes, well, we kind of think of ourselves as a bright spotlight on a very dark sea and point it at the right thing. And what we find so often is stuff that's been hidden by the darkness.
Yeah.
And then we talk to people like you who say, Jim, you're not scared to talk about it. I mean, I talk to people who've been banned from certain financial shows because they're not a bunch of yeller sellers, as I call them.
Yes. Exactly.
Where things are going bad, they tell you, here's a lifeboat, you should jump in it and then row for the shore. And others are telling you, jump on board the Titanic, you know, you've got lots of great seats left.
There's another thing we haven't discussed, which is grains and coffee and cocoa, that stuff we cover, and we do very well with that. And again, how would we know anything about that stuff without cycles? You know, it's only cycles, and the cycles somewhat predict weather.
We can't do our morning show without coffee. We did have that big jump in coffee last year.
Well, coffee and cocoa, let me see the last time we covered coffee. It was not too long ago. Coffee was, we covered it January 11th. It reached our downside at 165 as expected and bounced again. Cycles bottom to close up at 185 gives a buying signal with a first upside target 209. So coffee's on a bounce.
Cocoa?
Cocoa should hold 27.11. If not, we're going to get much lower price targets. That's what we said recently. So here we're basically saying the math determines everything. Cocoa, we said in December 1, it continues on a sell signal, have a downside target of 27.05. Cycles are down low by late January. So we're near a low, or even in it at the moment.
And of course, grains for Canada, right. That's a big part of our economy.
Corn, in December 1 gave a buy signal. Wheat gave a buy signal. Copper, which everybody wants to know, sell signal, still go lower. That's why people should get it, because they'll watch our shorter term, medium term, and longer term calls on all those commodities.
And David, maybe that's why maybe we should remind people again about the special offer you have.
Great. Charles Nenner Research, all listeners, go there, say you heard us speaking. And David, me, is offering a free month of the research to see if it's helpful to people. We do not manage money. We only do research. We only tell you what we see. So it's really brutally honest. And I think people like it. We got clients in 60 countries, and Charles used to be at Goldman Sachs, so what he writes here and the other team members that do it, I'm the editor, is quite astounding and quite accurate, and we hope your listeners have enjoyed this and get a chance to say hello to us and see what we could do for them.
And David, always fun to talk to you. Like you said, you can be honest. You don't have money tied up in this. The only money you have is the advice you give.
Correct. We charge for the advice, different levels of service. I look forward for people to be in touch with us. We do make it affordable for whoever they are.
And your website?
Is charlesnenner.com.
Thanks again for talking to This Week in Money.
That wraps up our show for this week. Comments or questions for This Week in Money can be emailed to info@howstreet.com. Thanks to our guests, Ross Clark and David Gurwitz, and thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.